Hello and welcome to our channel. In today's video, we'll be discussing another interesting, or maybe we should say concerning, phenomenon in the financial world. It's the interplays between money market funds, potential bank runs, and the looming debt ceiling. Together, they create the perfect storm for a crash. We'll explore each of these factors in detail and explain how they can lead to a financial crisis in the current macroeconomic backdrop. Have you heard about safe haven investments? They're supposed to be the go-to option for investors when things get a little shaky. Money market fund is a classic example of such safe haven instruments. But lately, money market funds have been acting like a destabilizing factor, absorbing a ton of cash from bank deposits. Sounds crazy, right? Let's dive into the mysterious world of money market funds. What are money market funds? Money market funds are a type of fixed income mutual fund that invests in debt securities with short maturities and very low credit risk. They provide excellent liquidity and ultra-low volatility, making them an attractive investment option for risk-averse investors. These funds can invest in either taxable or tax-exempt government securities, depending on their investment objectives. As open-ended funds, they can sell unlimited shares to customers and sell or redeem them at a price equal to the daily calculated net asset value, or NAV. The managers of market money funds typically strive to maintain a stable NAV of $1 per share through specialized pricing and valuation techniques. However, some funds allow their NAV to fluctuate based on the current market value of the securities in their portfolios. Overall, money market funds offer a low-risk, short investment option for those seeking stability and liquidity. What is the return on market money funds? Let's take a look at the Vanguard Federal Money Market Fund, or VMFXX, one of the largest in the US. According to Vanguard, this fund invests at least 99.5% of its total assets in cash, US government securities, and/or repurchase agreements that are collateralized solely by US government securities or cash. As such, it's considered one of the most conservative investment options. Here's a portfolio summary of the Vanguard Money Market Fund. As you can see, the average maturity of securities in this fund is just 12 days. This means the fund primarily invests in short-term US government securities, and the amount of income a shareholder earns is largely dependent on the prevailing interest rates. The Federal Reserve just raised the Fed fund rate to a range of 5% to 5.25% in the May meeting. What this does is it basically allows investors to enjoy a very generous yield on the return for one of the safest investment vehicles out there. If you have money deposited in a bank, do you know how much they are paying you in the interest? Despite a Federal Reserve's aggressive hiking in the last 12 months, national average yield for bank savings accounts is just 0.24%, but if you park your money in the Vanguard Federal Money Market, you'll get a 4.89% as of May 2023. There are actually many funds out there, and they all have much higher returns comparing to bank savings. Do you want your money to grow at 0.24% or 4.89%? That's a no-brainer. If you can borrow money, pay an interest rate of 0.24% and invest it to earn 4.89%, would you do it? That's essentially what the big banks are doing, except that they're taking advantages on the average savers like you and me. That's exactly the reason inflows into money market funds have been red hot lately. Investors want a better option than parking their money at the banks, because of the Federal Reserve has been raising interest rates rapidly to tackle inflation, and because of the short duration of the instruments held by money market funds, they can pick up the increase in rates lightning fast. In fact, the overall investment in money market funds in the US has surpassed a whopping $5 trillion. Sounds all good. What's the catch? Aside from money market funds, do you know that as a retail investor, you can buy bonds directly from the government through the Treasury Direct website? Well, it turns out that investors have been doing just that, causing a surge in the purchase of T-bills. This puts the banks in a dilemma. If they want your business, they would have to increase their interest paid to you. That will decrease their profitability. But if they don't do anything, money will continue to leave the bank's reserves and flow into money market funds or T-bills. Either way, bank reserves drop and the fears of a bank run may become a reality. Let's take a closer look at the damage caused by this destabilization. The most recent victim is a West Coast regional bank called First Republic Bank. Its share price took a massive dive in 2023 due to the failure of Silicon Valley Bank and the subsequent bank run fears. In February, First Republic was trading around $140 a share. In less than 3 months, First Republic's price fell to a single digit and was eventually bought out by JP Morgan. The downfall of First Republic was triggered by its poor quarterly results, which showed a loss of $100 billion in deposits. How many regional banks out there are facing the same issues as First Republic? If we examine the total US bank deposits for all commercial banks, we can see a sharp decrease in recent years, while the reverse repo, which the Fed has been doing primarily with money market funds, has increased to over $2 trillion. This trend is troubling and could have far-reaching consequences for the banking industry and the economy as a whole. Is debt ceiling the final punch? Money market funds are going bonkers trying to lay their hands on those short-term USD bills, and lucky for them, the Fed has got plenty. But hold on tight because things might get ugly if other regional banks start seeing a deposit flight. Big banks like JP Morgan might have a better shot at keeping their deposits intact since they're viewed as more reliable, but the recent sell-off of First Republic has set the alarm bells ringing. Banks are in a bit of a pickle here. Raising deposit interest rates will eat into their profits, but if they don't, a bank run can hit them hard and no bank can survive that. The US government is understandably anxious about the potential destabilization of the banking system and deposit flights. One thing that could trigger the inflows to become outflows is the looming US debt ceiling. That's something to watch out for. The US government's debt ceiling has always been a political game of chicken, with lawmakers usually coming to a last-minute agreement to raise the ceiling and avoid a potential default. But this time around, markets seem to be much more worried about the possibility of a default, and the numbers are reflecting that fear. The credit default swap market, which is like an insurance market for the possibility of the US government defaulting, is showing 2% probability of default, the highest reading ever. The debt ceiling basically puts a limit on how much debt the US government can issue until Congress approves it. Without a lift on the debt limit, there won't be any short-term T-bills that investors or money market funds can purchase. If that sounds bad, things can become worse, a lot worse. If the Congress does not approve the debt ceiling, the US is going to default on its debt. This one is the big tsunami, the really disruptive and catastrophic scenario that could cause a rapid and huge reallocation of capital. Things that were once considered the safest, like US Treasuries, would now be seen as risky. This would be a massive shakeup in the markets, and money is likely to flow to assets like gold, Swiss franc, or Japanese yen. Let's cross our fingers and hope that Congress sorts it out sooner rather than later. That's all for today's video. We hope this discussion has shed some light on the potential risks associated with bank runs, money market funds, and debt ceiling. As always, it's important to stay informed and be prepared for any potential economic downturns. We encourage you to do your own research and stay up to date with the latest news in the financial world. If you found the video informative, please give it a thumbs up and subscribe to our channel for more insightful content. Thank you for watching.